If someone asks you to do this, you better really know them or you better really trust them. We're talking about co-signing for loans. Shaun Mitsui is here from Bank of Hawaii to tell us a little bit more. Shaun, thanks for coming in.
Thanks.
Okay,
man.
so basically when we're talking about co-signing, what are we talking about?
Okay, well, Steve, when you co-sign for someone else's loan, it's like you're basically agreeing to guarantee the funds if the borrower were to default. It's like also being asked to take a risk on something that a professional lender would not take themselves.
Yeah, so you're basically vouching for the other person. I mean, this is a situation where you really have to trust the other guy, right?
Definitely.
Okay.
Yeah.
What are some of the things that you need to look into, some of the things you need to consider?
Some of the things that you want to consider before co-signing for a loan is, one, you want to make sure you can afford to pay the loan. Two, according to the Federal Trade Commission, studies have shown that for co-sign loans that go into default, as many as 3 out of 4 of them, the co-signers end up paying for it themselves. 3, collectors will take the path of least resistance and go after the person who is most responsible to recover the money. And 4, fees and collection costs. Not only are you responsible for the loan itself, but you're also responsible for any fees, collection costs, or interest payments that are associated with the debt itself.
So if I co-sign for somebody, can that affect my credit?
Definitely. That co-sign loan will show up on your credit report, which will therefore affect access to your credit. Not only will it increase your debt-to-income ratio, but it can also affect the amount that you can borrow. And if the borrower were to, say, go late on their payments or default on that, that will affect on your credit score as well.
Okay, so now this is normally seen, you think, with parents, with children, but at the same time, if I were to co-sign for a friend and they default on that, do I have ownership if I have to keep paying?
Not necessarily. It depends on how the loan agreement is structured. If you're not on the title or deed, the borrower can actually walk away with the goods, leave you to pay the loan all on your own, and not only that, but you have penalties and fees that you're going to have to pay for as well.
So is there any point where it's actually worthwhile to go along with this?
You know, if it's important for you for the borrower to get credit, then it might be worth your while. If you truly believe though that they will repay the loan, then yeah, it could be worth your while. Again, in certain situations, like you said, where parents and adult children, if the child, say, wants a loan or establish their credit, but they lack employment history or solid credit and maybe not have enough sufficient income to qualify for it individually. Also, like spouses, family members, if they ask you to co-sign to establish and build their credit as well, you want to help them out.
So just a bit of a warning, though, this could kind of really ruin relationships, friendships, all kinds of stuff. So make sure you know what you're getting into. Shaun Mitsui, Hawaii, thanks, appreciate it.
Thanks, Steve.
Okay, all the information on the website, hawaiiNewsNow.com. You guys stick around for more. You're watching Sunrise.